Did you know interest rates can make or break the stock market? Investors are feeling the impact right now. Welcome to how interest rates are affecting the stock market right now. Like, subscribe, and hit the bell for the latest financial insights. Let's dive in. The stock market is highly sensitive to changes in interest rates, and right now, rising interest rates are playing a significant role in shaping investor sentiment, market movements, and sector performance. Central banks, particularly the U.S. Federal Reserve, have been aggressively adjusting interest rates to combat inflation. And this has had a ripple effect across equities, bonds, and the broader economy. To understand how interest rates are affecting the stock market at this moment, it's important to look at the key mechanisms through which rate changes impact stocks, the industries most affected, and how investors are responding to the shifting economic landscape. Why interest rates matter for the stock market. Interest rates, set by central banks, influence the cost of borrowing, the availability of credit, and overall economic activity. When interest rates rise, borrowing becomes more expensive for consumers and businesses, which can slow down spending and investment. Conversely, when rates fall, borrowing becomes cheaper, often stimulating economic growth and boosting stock prices. At the moment, central banks around the world, especially the Federal Reserve, have been increasing interest rates to control inflation, which remains elevated due to supply chain disruptions, labor shortages, and strong consumer demand. The aggressive rate hikes have led to volatility in the stock market, as investors reassess the value of equities in a higher rate environment. The impact on different sectors. Interest rate changes do not affect all stocks equally. Some sectors tend to perform well in a rising rate environment, while others struggle. Here's how different industries are being impacted right now. Technology and growth stocks facing pressure. One of the biggest victims of rising interest rates has been the technology sector. High-growth companies, especially in the tech industry, rely heavily on borrowing to fund expansion, research, and development. When interest rates rise, the cost of borrowing increases, making it more expensive for these companies to finance their growth. Additionally, higher rates reduce the present value of future earnings. Many tech stocks, particularly those in the Nasdaq 100, are valued based on their expected future cash flows. When rates rise, investors demand a higher return, leading to lower valuations for growth stocks. Companies like Tesla, Amazon, and Meta have all experienced downward pressure due to rising rates, and this trend continues as investors shift toward more stable, income-generating assets. Financial stocks benefiting from higher rates. On the flip side, financial institutions, including banks, tend to benefit from rising interest rates. When rates increase, banks can charge higher interest on loans while maintaining relatively low deposit rates, leading to wider profit margins. Banks like JP Chase, Bank of America, and Wells Fargo have seen improved earnings as a result of higher interest rates. However, there is a catch. If rates rise too aggressively and trigger a slowdown or recession, banks may face higher default rates on loans, which could offset their interest income gains. The current market environment remains uncertain, with banks balancing higher profits from interest rate hikes against potential risks from a slowing economy. Real estate and housing sector struggles. The real estate sector has been hit particularly hard by rising interest rates. Mortgage rates have surged, making homeownership less affordable for many buyers. This has led to a slowdown in the housing market, with home prices in many areas beginning to decline after years of record growth. Real estate investment trusts, REITs, which rely on borrowing to finance property acquisitions, are also facing challenges. Higher borrowing costs reduce profit margins for property developers and landlords, leading to lower stock prices in the real estate sector. Companies like Zillow, Redfin, and real estate-focused ETFs have seen declines as a result. Consumer discretionary stocks under pressure. Rising interest rates also impact consumer spending, especially on discretionary goods. Higher borrowing costs mean that consumers have less disposable income, which affects industries like retail, travel, and luxury goods. Companies such as Nike, Starbucks, and Disney have faced challenges due to concerns about reduced consumer spending as interest rates continue to climb. On the other hand, Consumer staples. Companies that sell essential goods like food and household products tend to perform better in high interest rate environments. Investors often shift to defensive stocks like Procter & Gamble, Coca-Cola, and Walmart, which offers stable earnings even when consumer spending weakens. Stock market volatility and investor behavior. As interest rates rise, market volatility tends to increase. Investors are closely watching central bank decisions, inflation data, and economic indicators to gauge where interest rates might go next. Bond yields and stock valuations. Higher interest rates lead to rising bond yields, which make fixed income investments more attractive compared to stocks. Investors seeking safer returns may shift money out of equities and into bonds, causing stock prices to decline. Market sell-offs and rebounds. Each time the Federal Reserve signals a potential rate hike, the stock market reacts, sometimes with sharp sell-offs, followed by rebounds when investors believe the market has overreacted. This pattern has created a more unpredictable investment environment. Sector rotation. Investors are actively shifting their money into sectors that benefit from higher rates while avoiding rate-sensitive stocks. The movement from high-growth tech stocks into energy, financials, and consumer staples has been one of the most noticeable trends this year. What's next for interest rates and the stock market? Looking ahead, the stock market will continue to be heavily influenced by the Federal Reserve's actions and inflation trends. If inflation remains persistent, the Fed may continue raising rates, which could lead to further stock market declines, especially in growth sectors. However, if economic indicators show signs of slowing inflation, central banks may pause or reduce rate hikes, which could help stabilize the market. Many analysts believe that interest rates are nearing their peak, and once inflation is under control, rate hikes may slow or even reverse. For investors, this means staying informed and adjusting strategies accordingly. In a high-interest rate environment, focusing on quality stocks with strong balance sheets, stable earnings, and defensive characteristics can provide better long-term security. What do you think of our video? Let me know in the comment section below. Also subscribe to our channel before you go. Thanks for watching.